Today, we're diving into a really critical moment in database history. It's a story about how data was literally weaponized against perfectly legal businesses in a way that, for a long time, most people just brushed off as a wild conspiracy theory. For years, this idea of debanking, the government secretly leaning on banks to cut ties with customers they just didn't like, was totally dismissed. But guess what? It's not a theory anymore. Not even close. It is now officially documented, it's confirmed, and regulators are actually admitting it happened. So how on earth did they pull this off in the shadows? Well, the whole system was built around a single, kind of vague, almost harmless-sounding phrase that became this incredibly powerful data filter. The weapon of choice was called reputation risk. Now, when you read the official definition, it seems totally reasonable, right? Regulators defined reputation risk as just the danger that some bad press could hurt a bank's business. It sounds like standard procedure, just normal due diligence for managing legitimate business threats. But here's where it all changes. The gap between the official purpose and how it was actually used is everything. An examiner would walk into a bank and say something like, yeah, that crypto client of yours is legal, but they could pose a reputation risk. And that wasn't a suggestion. It was a code word. It meant one thing and one thing only: kill the account. So this practice, this shadow regulation, it went on for years, just operating in these gray areas. But then it happened. The theory was finally and undeniably confirmed by an official source. And just like that, all the whispers turned into a documented fact. Okay, but you might be thinking, sure, people suspected this was going on, but where was the actual proof? How could you prove that this wasn't just a few rogue examiners being a little overzealous, but that it was a deliberate, top-down policy? That was the key question. And then boom, they got it. This right here is the smoking gun. The Comptroller of the currency, Jonathan Gould, admitted it in a report. He said, point blank, that the guidance on reputation risk was used to deliberately discourage and prevent banks from working with an entire industry. In this case, digital assets. No ambiguity there. And with that one official admission, the whole system of unofficial pressure and these vague threats just came crashing down. The very foundation of shadow regulation, this idea of governing by suggestion and intimidation, it was completely shattered. Its era is officially over. So what happens now? How do you clean this up? Well, regulators are taking some really concrete steps to dismantle the weapon they created. First, they're completely rescinding the official guidance that allowed all this to happen. Second, they're basically deleting reputation risk as a standalone reason to do anything. And third, they're establishing a brand new, much clearer rule. And under this new mandate, the rules are crystal clear. Banks can only close accounts based on actual, quantifiable financial risk. A customer's politics, totally off limits. And you can't just debank someone simply because they happen to work in an industry you don't like. The justification has to be specific and concrete. No more ambiguity. But hold on, because the story doesn't end there, not by a long shot. In fact, it's just entering its next massive chapter. Now that the regulators have admitted their part, the investigative spotlight is swinging away from the government and pointing directly at the banks themselves. And this is the part that is just wild. The very same agency that was applying all the pressure, the OCC, is now launching a massive investigation into the large banks that actually complied with that pressure. You can't make this stuff up. So the core of this huge new investigation really just boils down to one critical question that they're now asking the banks. When you used reputation risk to close all those accounts, what was your real motivation? And there are really two main possibilities here. And frankly, both of them are deeply troubling. On the one hand, was it just regulatory fear? Were the banks simply scared, just following orders from powerful regulators because they were afraid of the consequences? Or, and this is the other possibility, was it more calculated? Did they see the government's pressure as a convenient excuse to get rid of new competitors, like all these fintech and crypto firms that were threatening their business model? Answering that question is going to require digging through years and years of account data, internal emails, risk assessments, the whole shebang. Finding out who got debanked, when they got debanked, and the real reason why, that data trail is about to become the subject of what could be the biggest, most consequential financial audit in history.